Hi, this is Michael. Welcome to Basic Options 1. Today we're going to talk about the basic understanding of stocks, options, and leverage. What is a stock and what is an option? We explain the difference between a call and a put and why you get such great leverage using options. So let's talk about stock first. So what is stock? So for our purposes, stock in a company is created when capital is raised, a new business opens, and shares of stock are issued. That creates ownership. You can't have a corporation without somebody owning it. So the shares are given to people that raise the capital in most cases, and that indicates their share or their ownership of the company. It gives you an opportunity a lot of times to have a piece of the company, have ownership in it without having to be involved in the actual running of the business. So I'll give you an example. Let's say I want to start a company. It needs $10,000. Okay, so I don't have 10,000, I have four. Okay, so I've got $4,000 to invest in the company, and I'm going to go to my brother, and I'm going to borrow $3,000 from my brother and $3,000 from my sister. So there's three of us involved in starting up this company. So 4,000 is my contribution. My brother and sister are going to put in 3,000 each. That's 10,000 that goes into the bank account, divided by their ownership. So I'm going to say that each share is worth $1. So $10,000, $1 a share. I get 4,000 shares. My brother and sister get 3,000 shares each. They end up with a 30% ownership of the company each, and I have a 40% ownership of that company. So let's say I go public down the road and I make the shares of stock available to the public, and it's trading at, say, $10 a share. Well, now you can participate in the ownership and profits, potential profits of my company for $10 a share. Okay, so you go to your broker and say, I want to buy 10 shares, 100 shares, 1,000 shares of Michael's company. You'll receive ownership in the form of a stock certificate. Now, they used to do stock certificates that look like this. Now it's done kind of electronically. A lot of the large companies like Apple and Facebook, they stopped issuing certificates a few years ago. So it's all done electronically. But you would buy shares of stock, and that gives you part ownership. Hopefully the stock goes up, and as the stock goes up, you make money. So if you want to make money with the stock going up, that's referred to as going long, being long the stock. Okay, so if you buy it for $10 and it goes up, you make money. Short is when you want the price of the stock to go down. So you would sell short. So those are the two positions. You can either be long or you can be short. And remember, there's always somebody on the other side of the transaction. So when you buy a share of stock, there is someone on the other end that is selling it to you. When you sell short, there's somebody that you're selling that to, another buyer. Now, as far as buying and selling stock or options, let's just take a quick review of bid-ask. So in the real world, in the retail world, if you want to buy a pair of shoes, you go to the, or sneakers, you go to Foot Locker, you see the sneakers you want, they're $100. You can't go to the manager and say, hey, I only want to pay 85 bucks. Okay? It's $100. That doesn't change. You can, however, shop around, go across the street, and they're selling them for 85 across the street. And then you can make a decision. You want to buy them there or you want to buy them for 100. It doesn't work that way in the stock market. The stock market is very fluid. The transactions aren't as static as they are in retail. Like I said, you can't walk into a store and say, I only want to pay 85. Well, the way the retail market works, or the free market, is the guy selling them across the street for $85 is probably going to have more sales because I'm going to shop there. The guy selling it for 100 is going to be, left out in the cold. He's not going to be able to sell that many at 100 because the guy across the street is cheaper. He's going to have to lower his price in order to be competitive. In the stock market, there's a similar situation where there's a bid and an ask. For every share of stock and for every option, there's a bid and an ask. The bid is what we are willing to pay, what we are willing to pay for it. The ask is what the seller is asking. We never, ever pay the asking price. So for instance, if the bid is 10 $10 for a share, and the ask is 11. Okay, they're asking $11. Well, I want to pay 10. Now, when you put your order in for $10, it might not go through. So you might have to bid it up at maybe, somewhere around 10.20 or 10.30, 10.40. The midpoint is 10.50. That's right smack in the middle. And you want to be somewhere from the midpoint over here to the bid. Do not be on this side of the transaction. Okay, so a lot of people want to figure out, why is it when I bought an option, immediately I looked at my account and I'm down $50. How's that possible? The stock hasn't moved. Well, that's because you probably paid the ask. And what your brokerage does, they calculate based on the midpoint. So they're going to assume that the midpoint of the stock is at 10.50 and you paid 11. So you're down 50 cents according to your brokerage statement. So you really don't want to be buying anywhere near the ask. Now, a lot of times the bid and the ask, the spread will be very narrow. It'll only be about a couple of pennies, but you always want to be a couple of pennies on your side of the transaction. And then whether you buy long or short, it's your broker that does this transaction so that you can have ownership, so you can have shares of stock. You won't have certificates, but it'll show up in your account that you have X number of shares or an options contract organizations. But I like TradeStation for their charging. So what is an option? Here's the classic definition. It probably won't make a lot of sense. I'll break it down into regular English right after this. So what is an option? Options are a financial derivative sold by an option writer to an option buyer. Remember, there's always someone on the other side of the transaction. The contract offers the buyer the right, but not the obligation, to buy or sell the underlying asset at an agreed upon price during a certain period of time or on a specific date. The agreed price is called the strike price. Now, obviously, if you're buying, that's a call option, and if you're selling, that's called a put option. So basically, it's a contract. An option is a contract of 100 shares of stock. One options contract equals 100 shares. Now, do you own those 100 shares? No. That's why it says you have the right to buy that stock at a specific price at a specific time. Now, what's going to happen is you're never going to exercise that right. You're going to basically buy the contract. If it's long, you're going to hope that the underlying stock goes up, the value of your contract will go up, and you'll sell your contract before the expiration date. There are call options and put options, and the price that you pay is called the premium. So let's talk about the different components of an options contract. There's calls and puts. Okay, so calls meaning you want the stock price to go up. A put is when you want the stock price to go down. The premium is what you pay for the option. The expiration date, and they're usually monthly. There are weekly options, but let's just to keep it simple, the third Friday of each month is called monthly expiration. So on that third Friday of the month, that's when the options contract will expire, assuming that you got the next month's expiration. You can buy December, January, February, March. You can buy next year's, but we're just talking about like the next month. That is typically what we look at, out about 15 or 20 days. So calls. Calls is a bullish position. That means you want bullish results or a higher price, like we said before. Puts are the opposite. It means you want a lower price. So, as I said, there's always another person on the other end of the transaction. So if you buy a share of Apple stock for 200, somebody sold that to you. If you own 100 shares of GE stock and you want to sell them and you place that order with your broker, they facilitate the sale to someone who is willing to buy it at your ask. So it's a bullish bet. So you buy a call option, you have a guarantee that the person selling it to you will sell you those shares if you choose to exercise it, which we already know now you're not going to. But it is a guarantee that they will sell you those 100 shares, if it's one option, 100 shares of that underlying stock at the price that you select. That's called the strike price. And you'd like to see the stock price go up, that increases the value of your option. If you're wrong and the stock price goes down, your option will lose value. So at expiration, the price is below that strike price that you selected, your call option is worthless. What is your loss? Your loss is limited to just the premium that you paid. Only downside risk you have when you buy a call option is the premium that you paid. You paid $2.50 or $250, because you always multiply times 100, because again, there's 100 shares of stock in the option. So if the premium is $2.50 for that option, you multiply that times 100 to give you your true price. So if you spent $250 on one contract and the price went below your strike price at expiration, it's worthless, and all you lost is the $250. Now you can get out of that contract early, but we'll get into that strategy later. Put options are the opposite, right? So when you buy a put option, you have a guarantee that the person who sold it to you will buy your shares of that stock at a price that you select, which is referred to as the strike price. You want to see the stock go down, which increases the value of your option. And just like with calls, the expectation is that you're going to sell this options contract before the expiration date. Okay? You want that put option to grow in value, which means you want the stock price to go down. Your options contract increases in value, and then you sell it before the expiration date. If you're wrong and the stock price goes up, your option will lose value. If at expiration the price is above the strike price, your put option will expire worthless, and then you lose the premium paid. Again, your downside risk is limited to just the premium that you pay. So here's an example. You're the buyer. You buy a $200 November 23rd Apple call. Okay, strike price is $200. So you buy a $200 call, and the cost, or the premium in this case, is $2.50, okay, or $250. The price goes up, you make money. So in this scenario, the price went up and it expires on the 23rd. So before the 23rd, let's say in 10 days, now Apple's trading at 205. Well, your strike price was 200. The difference between the strike price and where the price is at, if it's above, is your profit, less the premium. So the easier calculation is current stock price minus the strike price and the premium. So again, here, it went up to 205, 200 was your strike, 250 was the premium, so you made $250. Your risk was $250, but you made $250 on this option. They sold you that $200 call and collected $2.50 in premium. When you closed your option at 205, the seller actually lost $5 because they got to give back the $250 credit and they have to pay you the $250. In order to pay you $250, they have to give back the $250 credit. So they actually, $500 comes out of their account, of which $250 lands in yours. So when you make $250, they lose $250. And selling calls, which is not a good idea, naked, your risk is infinite. Let's look at the put scenario. So if you buy a $200 November 23rd Apple put, strike price $200, same thing, premium is $2.50. You want the price to go down, right? So let's say the price goes down to $195 and you sell it before it expires. Again, here's the calculation. Your profit is your strike price minus the stock price plus premium. So there's $200. That was your strike, okay? And now the stock is trading at $195 plus your premium of $250. You make the difference, so you made $250. And again, your risk was defined as $250. With the seller, sold you the put at $200 and he collected the $250 premium. When you closed your option at $195, they lost the $5, which includes the $250 credit. When you sell a put naked with no hedge against that, that's also very risky. Max loss would be $19,500 plus the $250 credit they received. Max loss is $19,750. Not something that you want to do. So there are many ways to buy options. You can buy calls, you can buy puts, and there are other strategies, spreads, butterflies, condors. We're going to get into that later, but at least you now have a basic understanding of what an option is, how to execute that option with the expiration date, the strike price, and the premium, and how you make money when it goes up or when it goes down. I'll see you at the next training called Leverage.